Hello, Jupiter. Welcome all. Welcome. Thank you for coming. Highly anticipate a bit of content from me. I'm sure you guys have been looking forward to this. Quite a lot of hype going around on it, so that's quite cool. Yeah, yeah. So I'm going to sort of start off today with a bit of introduction on who I am and sort of brief overview of what liquidity is, the two types, when we add volume to the equation, and some examples. So I'm going to keep it quite simple. It's probably about 30 minutes of your time. However, I think this could open your mind to some very interesting ways about how the market really works, how the big money trades, invests, how they look for basically entries and exits. So yeah, I'll get straight into it, and I'll let you guys know a bit about me. So yeah, I started trading in 2013, mostly buying and selling commodities and fiat currencies for a bit of fun. You don't know what you're doing at the start. You kind of like the idea of making a lot of money in a short amount of time, and yeah, you just kind of start dabbling around. And obviously, like everyone, had a fair few losses to start. Wasn't very successful to begin with. You learn what not to do, right? And yeah, after about 2 or 3 years of that, I finally kind of got into markets that I thought were a bit more pure. So like gold and silver and commodity kind of trading. Was really more investing here, to be honest. And yeah, then I discovered the cryptocurrency markets in 2017 and was pretty blown away with just how pure it was, and just love the idea of where the supply of an asset is quantifiable and demand is clear, and you can kind of just very easily work out, you know, market trends, where it most likely will go. Doesn't have those factors maybe you'd have in maybe shares or stocks, whatever you call it, where the market might have, I don't know, the CEO does something he shouldn't and causes an issue uh, that causes the shares to dump. The company could have sort of, unforeseen supply issues, and that could affect profit margins, etc., etc. You don't get this with things like cryptocurrency, commodities. Really, commodities more than crypto, but cryptocurrency is very pure, and that's why I like it. But yeah, so yeah, got into trading properly around 2018, 19 in the cryptocurrency during the bear market. Did very well, trading down for the whole year, and then stopped. Kind of sat myself there, and I went, right, let's just leave this alone for a bit. And yeah, stayed in an investment position really until end of 2020, early 2021, where I traded pretty much every day. Huge money to be made, as I'm sure a lot of the guys in this Discord have been through that, or did go through that. But yeah, so and I did very well, and I walked away near the top. So pretty solid performance, really. But yeah, I sort of stayed out the market all of last year. 2022. We're in 24 now, and yeah, started investing in October, and slowly between October and January, reallocated my entire position into various things. So, I mean, a little bit about me and my sort of angle in investing. I'm very much looking at exchanges where the money is actually made. So, most of my portfolio is centered around where money where money's made. So, no matter what currency you have, right, you always need somewhere to buy and sell it. And my angle on that was, well, the exchange is always going to make some money, whether it's a serious cryptocurrency like Bitcoin or something that someone just created out of thin air and it's just going up for the sake of it going up. But yeah, so a lot of my portfolio is focused around the exchanges themselves, and that's my core investment position. However, I do trade as well, but only at certain times. So I'll straight up with you guys, I haven't actually really traded since October. Opened a position which I shared with Gray and I shared with Jupiter, pretty much long in the absolute bottom of Cardano, well, ADA. And yeah, that was my last trade, really, to be honest. But yeah, I dabble in and out of sort of smaller swing trades, but I'm talking serious big size positions. But I do plan on getting a bit more active with this as the halving approaches and potential ETF gets approved. So yeah, why Jupiter? Why Jupiter? Well, I started speaking to Gray about 4 or 5 months ago, where I basically checked in with them and said, right, have you guys ever seen anything like this GAN system I've developed before? And both Gray at first and asked Jupiter as well, they said they'd never seen anything like it. I never actually explained to them how it works, but I think they were quite amazed by its accuracy. I shared with them sort of some of the information, and here we are. So I got approached on New Year's Day by Jupiter, and he said to me, "Look, why don't you just become an analyst and tell us how you make money on liquidity and GAN related theories?" So yeah, here we are. So let's crack on with it. So liquidity theory, liquidity. So liquidity is money. When we talk about liquidity, we are talking about the available money at a certain area to fill orders. It's as simple as that. Market makers, the big money, look for liquidity in markets to accumulate or distribute supply with a low spread. Okay, so you may have seen Wyckoff's accumulation distribution schematics, and you're kind of like sitting there like, okay, this is here to help me work out what the big money's doing, and yeah, how I can apply that to make money. So kind of the same vibe. A low spread is an area or zone where there is low volatility and high liquidity. Low spread is perfect condition for big money to trade large volumes of an asset without the market necessarily knowing that supply has been accumulated or distributed. And that's where Wyckoff comes in, where he's trying to identify these zones. It's effective to a point, but we're not talking about Wyckoff, we're talking about liquidity. So to find this liquidity, market makers look for two types of liquidity: outside liquidity and inside liquidity. So what do I mean by that? So we've got a definition that liquidity is just money, an area where that money will most likely be in good quantity and with low volatility. That's really the crux of this, what liquidity is. And big money hunts these areas, whether or not they want to distribute or accumulate, doesn't matter. They have their own reasons for doing whatever, but really they just want a point where they can transact with low volatility and a low price movement at that point. So liquidity defined: outside liquidity. Outside liquidity are resting orders that reside outside of a market's range of highs and lows. So when I'm talking about ranges of highs and lows, I'm talking about define a range, which we will do in an example. Look at where the market has gone the highest and the lowest, and they are your outside liquidity. So outside liquidity is a lot simpler than inside liquidity, which I've got to watch more examples for you guys. But different time frames determine the relevance of liquidity and the amount available, right? As we all know in trading, a higher time frame, daily, weekly, and monthly, is more relevant than and provides more liquidity than lower time frames or intraday, anything under a daily, whether that's an H4, an H1, or 15-minute candles. But outside liquidity mostly consists of stop losses and or traders providing liquidity to buy/sell other market participants' stop orders. Generally, that's how it works. So outside liquidity is an extreme of a market where most people, whether they're amateur or more advanced, will look to place a stop order in a kind of high or extreme low of a market to fully define whether or not they are right and wrong about a certain trend. Now, I use a different system. I use time-based stops, so I don't actually just leave stops in a market based off of certain price levels. I will wait until a certain time frame closes above or below my invalidation before I will close a position. But yeah, generally the market, most market participants, they put stops in a format that is based around price rather than time. But that leads to problems where you can get someone with big sort of money coming in and just eating those stop orders up, which is why outside liquidity really mostly consists of stop losses and or traders providing liquidity to buy or sell these. So let's define outside liquidity as best we can with an example on the chart here. And I'm going to turn on the old marking up tool so I can show you guys in the specifics of this. So this is a weekly time frame chart of ADA from the beginning of last year till June. Very simple, but we're defining a range here. So we've got the range low, the absolute bottom from the sell-off, the bear market at 2392, which is the absolute range low liquidity. And then from that move, this impulse here, we have got a defined range high liquidity here after a consolidation. That wasn't very accurate. There we go. And that defines at 4216. That's the range high liquidity from the impulse from the low, right? Then we have a consolidation here and a move down and then a move back up. So you can see here through this consolidation, which we're going to zoom into in a moment, which is why I've boxed it out for you. You got a market that's moved down, through, and back up, and what it's done is it's consumed this shorter time frame liquidity formed from this candle here, which I will show you in the next slide, and then carried on and gone up. Now, what it's done is it's gone to the range high liquidity at 4216, and it's completely blasted through it. But what it's done by consumption of this liquidity formed here, it has then found enough sell orders to transact, distribute, and then provide an opportunity for the market makers to force the market down with a straight arrow to our range low liquidity, which they have then taken as well. So this is a very easy, clear, defined example of how you have a very much a macro range low, a yearly low, a bear market low, which has a impulse away, a consolidation, which we'll zoom into in a moment, which I'll show you more specifics why, and then a second move up to consume the liquidity formed here to then allow for a trend change, a distribution here, and then a force down to here, where supply has been consumed again at the bottom in June. And, well, we all know what happened after that, don't we? So market pretty much bottomed at this area. And, yeah, low liquidity was consumed. But, yeah, next slide, I'll show you. This is the boxed off blue area that I had on the previous chart, where it's a bit of a clearer, sort of lower time frame example of high and low liquidity, or outside liquidity, I should really be calling it, where we've had the market, as you saw on the previous slide, impulse up, form a swing low as part of this consolidation that happened after this move here. So that is that candle. When zoomed in, it forms this sort of wave and makes a swing low liquidity, which then the market then makes a swing high liquidity and tests both here and here and a second time here. That's probably just the stop hunt before making its downtrend and going into a further consolidation. So that is here on the chart, coming down to the point here before it retests the macro high liquidity, which we've boxed out for you. But yeah, it's just an example of outside liquidity and how the market would run both here and here before trying to define a change in trend, or at least consuming orders. So quite a simple one. I'm sure a lot of the Discord already knows about this form of liquidity. So probably not a whole lot new for you guys on that one. But if we now transition nicely into inside liquidity, so this is where the fun is. This is where I'd say a small percentage of traders, a small percentage of investors have this nailed down. Inside liquidity. Inside liquidity are orders placed within the highs and lows of a range. So we just defined highs and low liquidity known as outside liquidity. But within that, we also have liquidity that's forming within that trend. Sorry, not that trend, within that range. Get the correct words. This form of liquidity normally resides in an area where the market has been inefficient. Now, what do I mean by inefficient? Inefficient is where a market has either changed direction or moved very quickly or impulsed away from a point and gone the other way from where it was going. So that's what we regard as an inefficiency. Now, these inside liquidity areas are formed from what are known as doji, or what my friend who taught me this terms as boring candles, forming before a change in market direction or an impulse move. And that's where this is usually found. So I'll just run over that. So impulse away or change in direction. With shares, you may also have heard of gapping. Gapping is where the market has closed and then opened at a different price than it closed, causing a gap in trading. This also happens with the Bitcoin CME chart as they close over the weekend and reopen. So gap fills, which I'm sure you guys have heard of in Bitcoin, but it happens in every market. These gaps are often targeted and filled with price action as they provide liquidity from unfilled orders resting there. So inside liquidity is inefficient areas of the market where the market has either changed direction or moved impulsively very fast or in a different direction than the market was trading beforehand. And yeah, and then that ties into this whole gaps thing for traditional markets. We're not talking about those really. Don't really care about CME, Bitcoin all too much. So yeah, inside liquidity examples for you. Right, what the fuck is this? You're probably thinking. Right, so what I have done here is I have drawn out an entire year range of Cardano, ADA, from the very bottom of the bear market down here. I'll circle that for you guys. And then we have our wave up, wave down, up, and all the way back down again, which we showed in our weekly candle outside liquidity area. This is that whole range here, right? So why have I put lines on these 5 areas? Well, these are areas where there is either a, and this is on a daily chart, by the way, either a daily doji, there's one there, and here, which I'm going to zoom into and I'll show you detail, or an area where the market has changed direction without a doji, known as a boring candle, which I will show in more detail, this red one here. And then we've got another doji up here, and we've got another doji before an impulsive move. So obviously these are direction changes. They're very clear. Point of direction change, there, 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 and there. This one is a consolidation after direction change to then have an impulsive move down. So this then consolidates and carries on. But so there are 5 points, 1, 2, 3, 4, 5, that define entire years of trading. So a lot of you guys are probably, I don't know, you probably use a lot of these traditional or, indicators that are easy to find, like RSI, MACD, all the usual suspects, Bollinger Bands. And you're probably thinking to yourself that these are kind of, they're pretty decent. I mean, they do kind of work. But a lot of them are lagging indicators. They're not leading indicators. They don't really tell you where a market's going to go that much. They help, but really, what I'm trying to say is we can make it a whole lot simpler, and I'll explain why. So these areas I've boxed off. I'll just zoom into these candles. This is the first one. This is this one here, the absolute bottom of the bear market. This is a doji candle. I know it's ugly because it's got a high wick, but it is a doji before an impulsive change in direction, which we can see happened. Now, candle number 2, another doji here, which at 4060 shown here before an impulsive move and change of direction down. Right, so that's that one. That's why it's boxed out. It's because it's the doji before the move, doji before it goes down, the clearest daily doji. Down here to my boring candles. So boring candles, these are more interesting. So if you do not get a doji or a clear defined kind of indecision candle, you want to look for a boring candle. And this is fucking boring, guys. It's just a smudge. It's just a blob. It was the candle of relevance than the lowest close before the change in trend shown here, and then a move up. And then we have 4511, another beautiful doji. This one's a bit cleaner, deriving another inside liquidity zone. Always take the close. I haven't mentioned that, so you've got the close here on that one, and the close here. There we go. And then the final, I don't know if I put that out, but that's the doji there at 4511. And the final one is our point here before an impulsive move down after already a change in trend, but a high volume change. High volume candle preceding this consolidation. And that one is there. And it's kind of a bit of a blob. It's more of a boring candle. Kind of a doji, but more of a boring candle. And yeah, so that leads me briskly on to show you, again with a cleaner chart, why is this relevant? Well, let's think about this, right? So you've got the 5 marked up areas here. How is the market behaving to all 5 zones? Let's call them zones. Now, obviously, after the price action has happened, we can then define it. So at no point have we retested 2458 yet. We'll come in here. Let's just go on a journey up to here at 4060. The market's formed this zone, and then down to here and formed a third zone. So nothing's been tested again yet, right? Then we have a move back up to 4060, and do you see these wicks? Do you see that there? That nice little cheeky wick there, and this one here. I'm going to zoom into these so it's a bit clearer for you. But the market's rejecting right? And that's a nice little swing. That's a 10% move down there. And that one, within those candles, I'm going to say is probably a 7% move back to there with the wick. But we'll zoom in so we can see it clearer. Then we have a move here. Another zone is set at 4511, and then a move back down. So move back down here. Intraday, I know that this had some support now. So it's a liquidity zone drawn from here, 4060. But that support failed and market moved through before moving back up to test it again, consume some more supply, and then reject. So this has shown, other than this, let's call it a deviation, that the this 406 has basically turned into resistance here, brief support, but really was resistance. And what I think's here happened is the market makers have targeted the outside liquidity formed from this candle with this move up here to then consume that before sending it back down and then respecting the inside liquidity again. But anyway, so we're moving down, and then we set our final zone at 3774, and then you can see price action from this point. Now this was under some real big kind of news. I can't remember what it was. Oh, it was the SEC coming down hard on ADA, and the market just basically fell apart. But intraday here, there is some action, which I'll show you at 3051. And then eventually it stopped at the inside liquidity and outside liquidity at 2458, and the bottom here at 2394, I believe. And then a change in trend off of that liquidity to then find up here resistance, very clean resistance. You see this at 3051. It is pretty spot on, right? We've got 2 wicks off of it on a daily time frame over 4 days, consolidating before moving down by a hefty, so that's about 18% move down. So that's an excellent trade before it continues to attempt and break through under high volume here before, look at this, going to 3774 and basically being the absolute top of that counter trend move before dumping back down to try and blast the lows again. So on the way back down, 3051 is now support. Guys, liquidity zones very clearly seen. You got wick to it and move up. That's a nice tidy 10%er. Move back down, a consolidation, a smaller move back up, but still a move back up before finally closing below. This is your get out and run signal here, and an attempt at a retest as markets makers are kind of trying to unload, but doesn't quite make it to 3051 before hitting our inside liquidity at 2458 and outside liquidity again to form the lows set recently through August, September, October. Very much magnetized to it here before going into a up only trend, which we're all familiar was a recent occurrence. However, on this way up, you can see again we do have rejection off of 3051, a solid 8% off there. That's a nice trade. Moving up to here, and there's some real volatility, but there is some defined resistance and then support and some good trades that could have been had there on lower time frames. And this nice excellent wicks to 4060 as well within that. So here to there, probably 10%, maybe a bit more, 15. Again, if you were targeting 4060, you could have got a nice 15%er. Before this bit of a obscure candle, probably volatility really there before it becoming support. You can see the support cluster here, and then it carries on. And it's already consumed the liquidity here, so it just blasted through it. And then this was an interesting one. You see it's high volume, so it just took that liquidity zone and then just carried on in one candle and consumed a fat load of volume when it was there. Moving on to the next slide, I'll just show that a bit clearer with the outside liquidity as well. So everything I just talked about, you've got the inside liquidity in white and then outside liquidity as well, shown as defined extremes of the range, where you've got the yearly low here for 2022. That was an outside liquidity, the bear market bottom, and then the impulses and highs and lows from those moves. So you can see how the market, as well as respecting the inside liquidity, when you combine it with outside liquidity, you've got some seriously good trading opportunities. In this range here, as we already talked about, there was an excellent example of liquidity being consumed before it moved down. Outside liquidity is a bit more prominent when it's an extreme range low, like 2392 or 4621. 2392, if we look down here, we are getting a lot more of these sort of wicks coming off of those extremes. Okay, so and the absolute bottom bit buy there if you bought that one. But yeah, yeah, inside outside liquidity. I'm now gonna go onto the chart and zoom into these areas just to show you guys a bit more kind of examples of how it works. But basically, this is defined by me one of the main ways that markets work and how they move between A and B. They're looking for liquidity formed inside liquidities from unfilled orders that have either because of an impulsive move like here happened and then forced the market down and there's a lot of orders left resting here that need to be filled up, or indecision, which again would mean that there was orders here that are unfilled and need to be uh, filled up as well, basically removing the inefficiency in the market. And it becomes areas that the market makers target because they know that's where they'll find some money, liquidity. And that's just how it works, really. All markets tend to follow this. And yeah, showing you clear on an ADA chart as well. So just going to go on to examples now of different within this range, different time frames, lower time frames, H4s and H1s, of showing a bit more detail about reaction at 4060 that we saw here, and down at this consolidation where you could have really punted some big orders, which I did, and I'm sure Jupiter and Grey did as well at the very bottom here as a retest of the absolute low in the bear market. So yeah, moving on to that now. Okay, so before we move on to the examples I mentioned, I did actually forget to run over one thing, and that's how do we confirm or deny whether or not a liquidity zone is going to provide resistance or support and provide a trade for us. And the way we do that was with volume. Okay, so volume is the amount of assets traded. I'm sure we all know that. Just it's the total amount of assets traded within the given time frame. And volume, when used appropriately, can indicate strength or weakness in a trend. Bulls want increasing volume in an uptrend with decreasing volume during consolidation. And bears, in that same uptrend, want decreasing volume and increasing volume during consolidation. A volume climax can indicate a potential trend change. You tend to see volume climaxes at pretty much bottoms or tops on markets, sort of macro bottoms or tops, huge volume bottoms, normally not so clear on tops. But yeah. And I use volume to confirm or deny the relevance of liquidity zones. So yes, we've drawn out our 5 inside liquidity zones and we've got our various outside liquidity zones. However, how do we know they're going to be relevant? We use volume to gauge that. And the way I gauge it is if volume is relatively low as price trades at a liquidity zone, a reversal in price direction is unlikely and the zone will be invalidated. So say your market comes up from, I don't know, it's from below the zone and comes up to it. And if it's under low volume on intraday candles, you can pretty work out that zone is pretty much going to be ignored by the market makers. If, however, though, the volume is relatively high as price trades at a liquidity zone, it is likely the market's direction will reverse. Right, so just going to tab over to the chart, and we'll have a look at those examples I mentioned on an H4 time frame. I use H6, but most people don't have access to H6 unless they pay for it on TradingView or whatever platform you use. So I use H4 just to show these examples in detail, volume, wicks off of zones, and how they can be used as a trading opportunity for you. Okay, so here we are. So we've got our inside liquidity marked in white and outside liquidity marked in blue. And yeah, let's look at some examples of how you could trade this, make some money. So we'll look at inside liquidity mainly. There's a few options with outside liquidity, but inside liquidity is where you'll find the better opportunities in trades. And lesser known theory, as I mentioned, obviously outside liquidity is quite well known in the market, as it's a place where stock losses lie, as I mentioned. Inside liquidity, lesser known, and they're good opportunities for you. So obviously we start here at the beginning of last year with our inside liquidity at 2458 and the macro outside liquidity 2392. And at no point in the market comes back to test these areas until we get our 4060 in inside liquidity form, and then we get the market moving after a swing down back into it. So let's look at what happens. So down here on the 31st of March, we've got this excellent example of how you could have sold in inside liquidity zone and made some nice money on it. So market comes up, at no point has it tested it yet. And then on this H4 candle, you've got a test through, exactly almost pinpoint, slight close above, but we wouldn't say this is a confirmation of the liquidity zone, and then a move away. You're probably asking, oh, how would I know to sell that? It could have just shot through it. Well, that's where the volume equation comes in. Do you see this big volume bar here? That 24.29 249 million. Substantial volume, but it's relative volume to the trend prior. So if you look at kind of volume bars here, they don't really exceed much above like sort of 20 million. And then you've got this high volume climax into the liquidity zone. So the trade setup would be you wait for the market to retest your liquidity zone, and then you go, okay, big volume, close on there with big volume. I'll sell that. Stop loss maybe a couple % higher, keep it safe, but yeah. Or time-based like I do, when you just wait until a certain higher time frame closes above. I'd wait for the daily to close above for me to, if it closed above, I'd close the trade if I went short. But yeah, so there we go, high volume. Next candle on the H4 is the sell. Invalidation is a daily close above, which it didn't. And then, yeah, the market moves down by a sweet, 10%. That's a lovely 10% trade there. You then get this secondary test. Again, on high volume, you see the volume bars are high. Very close. It's not always pinpoint, but it's very close. So you could probably have sold that as well and made yourself another 7 or 8% there. Market is struggling to go above, but it's consolidating sideways. After making your 2 trades there with some excellent defined risk and reward, and some excellent reward if you traded it, you have the market moving through it again. Now, this is the first tell of there potentially being weakness with this liquidity zone. As the more times the zone is tested, as we know, with certain levels, the less strong it is. So there's less liquidity there, less money, because it's being consumed. It's been eaten here and it's been eaten here. And you come to it for the third time, it's becoming a bit weaker. It's still a sell point, but I wouldn't have traded this myself. I only tend to sell the first or second test of zones. I don't do the third, surely because, as we mentioned, there's not a whole lot of money left because it's been consumed. And you can see as well the volume, unlike here and there, is lower. So there's a bit of a tell. That, another test of this, is probably not going to work. And it doesn't. As we can see, the market moves through, makes a new zone up here and a new macro high of the range for the entire year at 4621. So, looking through this, we've got our new zone new zone created here, and a move down. So the market, we'll just go and sort of find where we next get some examples of liquidity tests. So yeah, back on 4060 after a move above, and I'd say substantially reason for this is just to hunt the outside liquidity here and then move the market a little beyond it to find as much liquidity as possible before marking it down. The market comes back down at 4060 and actually uses it as support. You can see that here. And what are we talking about again? Volume, right? So market after going to 4621 and quite a large volume relative to what's happened prior, 16 million. We've got to move through the outside liquidity, but the relevance stands at the inside liquidity. Inside liquidity is stronger than outside liquidity. Always is. And here he is, literally pinpoint off 4060. It went to 4065. Very close. You can mark that as a point that you most probably would have taken a long trade, counter to the trend. And that bounce is solid. It's about 6% to there. If you move that, get the whole move. But you can see how it's acting as support. Then under low volume, so the volume's to tell again, it tests it, but there's no volume there, which means the level is most probably not going to be support. So you ignore it and it fades through. And then it's actually flipped to a bit of resistance here on a retest. Market then spends about a week trying to go back up, but under volume, see the volume, that red bar there, the green bar into there, bit of a deviation. It's not as clear cut with this one, but it's showing some resistance. Overall, this range with the volume, you can tell most probably the downtrend is now intact, and this is now a sort of sell point for the market. And yeah, it's a bit more volatile, yes, than the prior example, but you are getting a inside liquidity resistance and a sell point where you could then go short and the market just falls out. And it then goes down into our final liquidity zone, inside liquidity, here at 3774, which is marked from a daily boring candle before an impulsive move to the yearly low. So we go down, and as we're trading down, we do come across this inside liquidity again at 3051. Now, because of the nature of what was going on here, this H4 is under high volume. However, it does close through it. So this is the difference, right? So you were talking about examples of If there's high volume, you should probably go long if the candle body on the closes below, right? This is an example. Sorry, if the candle body doesn't invalidate it. This is an example where there's high volume, but it closes below it, and therefore acts as a point where buying on this much volume, I mean, relative is pretty fucking huge. And with the news going on, you probably would have taken your hands off the table here. However, you do move down to the next inside liquidity zone at 2458 and the outside liquidity, the macro low for the year at 2392, which, although there was a massive wick, does provide quality support. And the volume is huge. So it's support, right? So we're using the volume as a guide, liquidity zones with the candle bodies closing above or below, confirming or denying areas. And yeah, we get a lovely bounce trade there. You're looking at something like 20% if you take it all the way to there. And yeah, market moves back up where we find inside liquidity again at 3051. Pretty pinpoint this one. Look at that. Straight off it. High volume. It's not easy to see because the volume bars are distorted. There we go. Look at that. Relative to the trend, where's the volume? He's there. And it's that big boy here. And then leading up to it as well, we had some quite decent volume. So there's the tell. Good trade down. 10%. Second test on the inside liquidity. Obviously, outside liquidity is kind of working as well, but we focus on inside liquidity. It's more relevant. And we get a pinpoint accurate test again. Under, again, higher volume than relative to what's happened before. And the market moves down. We get a secondary test after a lovely sort of 20%er. You get another test, but this time using the outside liquidity as resistance. And then the market eventually decides that it's going to break through. So, high volume, but a close above, invalidating the area. If it was high volume and close below, we'd go short. That's the strategy. And then we move into our liquidity zone at 3774 on the H4. Huge volume, candle close below. Great short opportunity on this candle. Bit wide, I know, but still very much pinpoint the top on that one. If you zoomed in probably onto lower time frame candles because it's so volatile at this point, you probably would have seen a better structure here. Probably lasts for an hour on 15-minute candles where it's distributing. And you would see the volume and you would work it out. But yeah, it comes back down, tests again the 3051 and acts as support. A nice little 10% trade there. But we're coming back to it again, and the volume is slowly decreasing, and the market is not really acting so well. Support here, not much of a bounce before it fades through under volume. See the candle below. Yes, volatile comes back above, but this is the tell that this is no longer really acting as support, and it fades through. And then we have underneath here a secondary kind of test of this outside liquidity at 2980, and an inability to get the inside liquidity at 30. 5-1 before forming our final breakdown before the low was formed. So you can see here it comes back, hits inside liquidity and outside liquidity again, and then it spends a good almost 3 months churning on this inside liquidity with some very pinpoint accurate H4s and some sort of volatile action down to the outside liquidity where supply is being consumed. The volume bars, you can see all this volume, and then we've got this final little move down with this pinpoint accurate test of the macro outside liquidity before our markup. But we are still getting resistance at these blocks here, and the perfect inside liquidity here. A little bit here on the outside liquidity. And yeah, we finally get through it with a retest. And yeah, I mean, you could have shorted here. Volume relative to what had happened was pretty high here, fading up into it. And then a move down, that's a nice sort of 10% of there. And then, yeah, moving through, forming again into this lovely uptrend, which we've just happened recently, where each level is getting attacked. Some volatility, some volume there. That was a nice trade there. You can see perfect close below. You short that with a stop above there if you want to trade it based on price. And yeah, it's a lovely sort of volatile 10%er. And a secondary example here, but this one's a bit of a funny one. So price goes through, sort of hangs out on top before a fade down. Not so clear cut would have ignored it just because of the volatility. But this lovely first test of the inside liquidity, lovely 15% move down. So yeah, I'm showing you examples pretty much all through to the end of the range. But you can see, really the crux of this is, you can see where the candles intraday are using more inside liquidity, but also outside liquidity as points where the market is finding interest, whether that's for shorting or longing on a smaller time frame to then confirm direction and offer trade opportunities for you guys. This is how the market really kind of just moves around. It defined a range with 5 inside liquidity and a couple of outside liquidities, and just moves between those for an entire year. So you can intraday trade very well using these options and examples. And I hope I've made it clear. But any questions, I will be about. Glad you guys turned up to have a look at this. And as I mentioned, this is part of this series. So today, also, I've only talked about liquidity theories, inside outside liquidity, where market makers target orders and how they generally find and distribute to the market. And my next example will be my own theories derived from the works of the mysterious but very successful trader W.D. Gann, which is similar to liquidity theory. However, it uses a conversion from time into price levels. So it's quite advanced, but it adds to this theory I've just taught you guys. And with that, and a combination in a trading system, provides very high probability examples trading that basically can make you some money. So we'll come back to that. Hopefully next week I can get that published to you guys. But I hope this makes sense. I haven't rambled too much about the examples here, but thanks for checking in. Thank you so much for your time, and I hope this has broadened your sort of tool set and sort of shown you a bit more about how markets actually really work and what market makers are generally, how they trade and how they look for liquidity, really just to fill up orders for their clients or for themselves.